Welcome in. It's another Sunday here, and we are kicking off with a different format today. This is the intro to market making. We're going to have beginning or becoming a market maker coming up in the future. So that's why this is going to be a collaboration between our community and Beautiful, which is a collab by traders, for traders. Hope you guys enjoy it. Me and Andrew have put in a bit of time into just explaining, how things work. And so here's the agenda for today. It's going to be roughly about an hour. We'll be going through the options flow positioning first. Andrew will be covering the intro towards that and the intro towards dealer mechanics so that you guys can also better understand these Sunday sessions. One of the things that we constantly get questions about is the fact that how do you use the data? So today we are here to further enhance your learning into how to use that data that we talk about every Sunday. And more importantly, it's to show you that there is a part of this market where it's very sensitive to information. It's you can act on information and how to use that information. We'll then have a 5 minute break. We'll also have a special announcement. So stick around for that. And then we'll go into the next part, which will be by me, the introduction to unusual options activity, some pros and cons of options activity, and then how do you read the data behind it. We'll end with Q&As. So save all your questions and put them in the chat when you have them. And then, we'll kind of go chronologically. So if you want your answers to be first, then put your questions first, because we'll go by, who asked the questions first. Okay, great. So hold on 1 second. Sorry, someone's asked me for the link. Let me just give it to them. Okay, it's good now. All right, let's start. So Andrew, you want to take it off?
Yeah, I'm gonna share my screen because I already
For
have
sure.
the
Yes. Go for it.
cool.
Will there be a replay? Yes. For premium members of the Discord, you'll be able to see the replay.
There we go. All right, so let's kick this thing off. So, like a lot of you, right? I was a long-term investor, stumbled upon short-term trading when everyone else did. One of the things that caught my eye when I started this was I like to understand every aspect of what I get into. And so I started diving into the world of options and what is it really? And I think there's a big misconception, right? Everybody buys a contract and they think they're the only person or the only piece of that position. And I'm here to let you guys know that there are multiple players in the market in every single position that you see. So when you see an alert within whatever Discord you're in and it says, hey, options flow is popping up on Apple, right? That means, right, they bought calls for Apple, but there's multiple aspects to just that one position. And so here you have a visual of the players, right? So you have two pieces of information that you need to understand when reading options activity or before you decide that you want to add risk to the market. So you have the customer side. The customer could be anybody from hedge funds, right? Big corporations in New York, massive retail traders. Me and T were just having a conversation about a guy that we know from a trading group who made $1 million in one day. And he's a retail trader. He's not an institutional trader. He's just a big player in the options day trading world. They can also play an impact on positioning. Institutional traders, right? The individual traders at these desks that are making the trades in the moment, right? And building these positions. And then, yes, you have these furu traders on Instagram that are pumping these contracts, feeding all of this FOMO bullshit and all this stuff, right? So, understanding that the customer is one side of the trade, but that's not the most important piece. The most important piece is the dealer or market maker. And you've probably heard me talk about this if you come to the Sunday sessions. You've heard T talk about it. You've seen it posted in the Discords, right? The market maker slash dealer is the individual who is driving the market. And so this could be a large hedge fund that is selling those contracts. Could be brokers, right? Your brokerage is also playing as a market maker. You have hedge funds, well, that's supposed to say institutions, sorry. Institutions, and then furu traders, maybe again, right? With this facade that, hey, we're out here making all these big moves. But the most important thing to understand is when you see options flow and you see positioning, there are multiple players within that position. So we are just one, right? When we buy a contract, we are over here. But that means there's somebody over here that has a different outcome that they're looking for. Okay. They either want it to go up or down, the opposite of what we are looking for. Okay. So keep that in mind because when we get into this next slide, we're really going to dive into what happens when these players start to move the market to position themselves. So let me move this down. That brings us into dealer mechanics. This is where we're going to spend majority of our time. So most people buy a call, right? You buy a call, you go long. So let's say you buy a SPY 610 call and you're like, okay, I bought this 610 call. I want the market to go up. And that's all you really think about. You don't think about who sold you that call. What actions does the person who sold you that call want? What happens if that call goes against you? Who's going to drive the market up? If the market goes in the right direction and your call goes in the money, then what happens? Right? So let's just explore that for a second. So you buy a call. That means the market maker or dealer has to short that call, meaning they're selling you that call. Now, if any of you have ever sold a call before, when the market goes against you, that money comes out of your portfolio. And that money goes into whoever's portfolio you sold that call to, right? So when you are in a position, let's say you bought that 610 call and you're all of a sudden up, let's say $100, right? That $100 comes from this person, comes over to you. When your position is down, that money goes from you to that person, right? So there's always somebody else on the other side of that trade. And that happens for every single trade that is going on in the market. Now, where this information can help you is if you can identify where the largest amount of positions are being built and you can position yourself with the market maker, then you have an advantage, right? And we're going to talk about that data when T gets into some of the options flow and what we're looking for when we're reading the options flow. But it's important to understand that when you enter that position, you are not the only player in the market. There is another person over here that you can't see, or you don't know what they're doing, and they have an invested interest in the position that you just bought. Okay. So that goes for both ways, right? So let's say you go short. Well, if you go short, that means the market maker is short the put. Therefore, let's say this is your position and you want the market to go down, right? That's how you make money. Well, the market maker has to sell you that put. So they want the market to go up. So again, right, you're looking at it from one aspect saying, hey, I bought a put. I think the market has to go down. Somebody has to sell you that put. Therefore, they have to take on risk on the other side of the trade. And depending on what the price action does, that's going to decide what the market maker's actions are. Now, this is important because the market maker is the one who's driving the price action in the market. So if you don't know who is driving the trade, you're going to be frustrated. You're going to be like, why isn't the trade going against me? Or why isn't this working out? Or how come the market feels rigged, right? And a lot of the times it's because people have this a belief, again, that they're alone in the market and that they can just buy this one position and everything's going to go their way. And it doesn't work that way, right? So every single action from an option standpoint, whether it's a buy or sell, has a secondary point from the market maker. So we already went over long calls, then they have to go short. If you go long puts, then they have to go short puts. And now you get into, well, if retail traders or customers start selling positions, right? You're looking at flow and they're starting to sell. Well, the market maker is on the other side of that. So let's say all of a sudden some big institution goes, you know what? We don't think the price is going to go over 610. So we're going to sell a bunch of 610 calls So we think the price needs to stay below 610. Well, the dealer has to buy those calls. So now the market maker is on the other side. They're playing the market to the upside. So if the price breaks over 610, the market maker has no actions. They could just be like, look, we don't care. We're in the money. We're going to buy these shares anyways when the contracts expire. And if the market goes higher, we don't care because our contracts go up. And the customer's on the other side of the trade. And they're the ones who are starting to get messed up, right? I'm going to get into how they have to hedge just in a second. So I'll get there in just a second. But again, right? Understanding that there's two parts to every trade, and that's just one position. Now take into account that there's multiple positions on every single trade, which T is going to get into later on when we talk about part two of all of this, when we go into real deep into market making. But there's multiple positions to every trade. So when you see an options flow and you're like, oh my gosh, Andrew, they bought $2 million worth of uh, AMD calls. The market has to go up now, right? The answer is no. It doesn't have to go up. That could just be one leg to the position. And so now we need to look at that and tie it to the other information that we have to then to decide if we want to take risk or not. So don't look at options flow as like an end all be all piece. Look at it as a puzzle piece. And you're trying to fit it into the puzzle so you can get the full picture of what is the customer, who is the market maker, and where do their actions change. And if you can grasp this concept that there are multiple players to the position, it will really help you understand, like, should I be applying risk here or not? Right? It's one of the first things I always ask people is like, okay, why are you applying risk? And they're like, well, I saw calls being bought. Well, that's just one piece of information. We have to dig into it more, right? So always understand, and this visual's in the Discord. I pinned it in the VIP channel, and I'll post it in T's Discord as well. So you guys always have access to it. But this visual right here, if you can grasp this concept, it will really help you understand like when do you apply risk just because you see some options flow. That doesn't necessarily mean that the customer is going to win. The market maker might win, right? And you don't necessarily see the market maker's position because the bots only pick up the buy order. They don't pick up the other side of the trade, which I'll show you guys. Like, for example, real quick, if I pop into here and I show you guys real quick, like a market maker's position. So you can see right here, for example, I'll show you guys in real time. So here's SPY. Here is December 13th. And here is the 606 calls, right? And there is the buy order, $6.9 million. Okay. So that's the buy order. So that's telling you, okay, somebody bought $6.9 million in contracts, 606. Now, if I take you to the market maker and we go to the same expiration right here, now you can see that the market maker is short. The customer is long, 606. The market maker is short, 606. So what happens when the price gets to 606? The market makers now have to buy shares to hedge their risk, therefore creating a squeeze to the upside. You can see it right here. This is 606 right here. And you can see how price squeezes off of that, comes back down into it, and they buy off of that level again. So you can see how that options flow, although it's the customer's flow, there's also another side to that, which is the market maker's position. So understanding that there's two sides to every trade will help you guys better understand should you be applying risk or not. Now, how do you start to use this information, right? That's obviously the number one thing you want to understand is now I need to use this information to be able to decide where do I take risk or what side of the trade am I on? Do I want to be on the customer side? Do I want to be on the market maker side? Me personally, I like to be on the side of the market maker because in my experience, I've seen more success there. So if we move into the next slide, you'll see two visuals here of price action. So what happens is exactly what I just showed you, right? Somebody buys a large position. That large position draws a line in the sand, which we call a gamma level, right? Which we'll go into more detail on in the next classes in 2025. That creates a key level here, which is a gamma level or a buying pressure, a selling pressure level, one of those things. The market maker, let's say for our example, sold calls here. So they sold calls, we'll say 610 calls. We'll use 610 as our level here. So they sold these 610 calls right here. Once the price breaks this level, because the contracts are now in the money, the market maker has to buy. Okay? So now that you've broken this level, the market maker has to start to buy shares to hedge their risk. Because again, right, a dealer or a market maker has to hedge their risk. They can't just sell the contracts and then be like, okay, that's it, right? They have to take actions after the fact. So once it breaks that level, the market maker then has to become a buyer to hedge the risk. So for every dollar that SPY goes up, you multiply it by 100, right, for one position. And if they're selling 50,000 contracts, you're talking about millions and millions of dollars of risk that they're taking on, and they have to hedge that. So what you're looking for as a trader is you're looking for the flow to give you indication of a large position being built. Then you're doing research to understand who's at risk at this level and what could the price action be after we break this level. Then how can I position myself to capitalize on that, right? Because if you know that 610 right here is the level and price breaks it, then you don't have to worry about going short until price comes back down below this level. Because as long as price sits up here, the market maker has to hedge their risk every time the market pushes higher. That is how we use this information. So when you're coming to the Sunday sessions and we're talking about, hey, there's a key level here. We just saw this flow right here. This 605 level is really, really important. I'm telling you guys, this level is pretty important. If price gets over this level, then I think we can go to 610 because that's the next level that I see. What the data is telling me is there's a massive amount of contracts that have been sold here. And if price breaks this level, whoever the market maker is, I don't know who they are, whoever that market maker is, has to hedge their risk, therefore becoming a buyer, which then creates that buying pressure, which pushes the market higher, right? And the same is true when you look at the downside, right? So if you know that this is the level and price breaks this level, then all of a sudden the market maker has to sell shares short, which creates the selling pressure because they have to hedge the risk of the contracts that they sold at this key level, right? So the customer is the flow that you see through the bots and everything and the AI systems and all that stuff, right? You see the buy orders. You don't see the shadows of the market makers' positions and how that creates their system and then what their actions have to be after that. Okay. So really, really important when you guys are reading options flow and you're following these bots or you're following these systems or you're looking at this information because these scanners kick out a lot of information. Just because you see an order come through doesn't necessarily mean that the market's going to move in that direction because there's so many different components that go into a contract being bought and sold. And a lot of people miss that fact, which is why you see people on Twitter posting, oh, hey, they just bought a bunch of puts right here. The market has to fall. And you're like, those could just be hedges. They could be part of a bigger leg of an options position. It could be the sixth leg of a eight-leg position that that institution has. We don't know all of that information. So we need to be cautious when we're reading flow to understand what piece of the puzzle is this telling us? And then how do we use that information as traders to be able to position ourselves to maximize the profitability and limit our risk, right? So that's one of the reasons why when you guys are listening on Sundays, and I might say, Well, you could get in here, but the risk isn't that good because you've got a wall $2 above you. And so unless you break that wall, it's not going to create another buying explosion from the market maker. Therefore, it could reject there, right? And so maybe you missed some of the move. And so it's not a good place to apply risk, right? That's really what, what I'm trying to share on Sundays when I'm talking to you guys and I'm explaining it is looking at this. If I know that there's, a wall there, unless I see the market maker start to buy shares and push through the wall, it's just not a great place to start to apply risk because the risk to reward isn't that high for you. Just because you see the flow there on the bot doesn't necessarily mean you're going to see this upside, right? Because it could be part of something bigger. We just saw that with AI. AI, we saw puts being bought, and then Friday, AI ran like $4 or something. So if you followed that flow blindly, you would have lost on that trade. So it's important, right, to understand, different aspects of the trade and how do you position yourselves for it. So this is just the starting point because what T's going to walk you guys through is he's going to walk you guys through what the options flow actually looks like and how do you look at that flow to kind of start to find those pointers to help you. And then as we get further into this in 2025, we're going to dive really deep into like market makers' environments, how they position themselves within those environments, how do those environments help you better understand when to take risk, what kind of price action can you see in those environments, right? We're really going to dive into how do you then use this information to better understand the environment for the market maker and what you can kind of see from it. So with that, that's going to take up the first part of the day. I'm going to hand it over to T. We're going to make an announcement here and give you guys a little break, and then he's going to walk through the other side of it, which is the details of the options flow.
You want me to share my screen real quick?
Yeah, you can share your screen.
All right. Okay, so we are gonna give everyone a 5-minute break right now. In case you want to go to the restroom, you want to, get some water. But we also do have an announcement. So for those of you that are here, just out of our collaboration and this webinar that we are holding, we want to intro you to something that we have been working on for a little while. So this event that you're attending right now, Intro to Market Making, is going to be a part of a 3-part event where this is the first intro to it. The next is going to be becoming a market maker. And then the third is going to be positioning it like a market maker. And we'll be holding a 2-day course, which is going to be a crash course on January 18th and January 19th of next year. It'll be the same schedule, 7 p.m. PST. And what you're going to be learning during this is who is the market maker? How does the market maker get paid? What is the MM's incentive? How does the market maker impact price? How do you spot smart money? And then also understanding unusual options flow deeper. So it's more deeper than what we're going through in this session. It's also remember that when we talk about the market maker here, why are we obsessing about the market maker? Because we want to position ourselves like the market maker. So in order to join the market maker's journey, you have to learn how to be like one. And so that's what the idea is. And we're going to teach you all how to convert your mindset into the market maker mindset. We will be holding a early bird sale, which will start today and will last until the end of December, roughly 22nd of December. People who sign up during this period of time, there will be 30 spots only, will get the course at a discount of $291. And then the general sales will start at $388 after the December 22nd. Okay. So all the information is here if you need it. And if you have any questions, you can always reach out to us. This is going to be very impactful for people who are day trading and especially for people who are swing trading. These two groups of people, you want to take this course because it is important for you to understand the background of the market. And I always keep saying, you need to understand the structure. Well, this is the moment for you to get everything in one place and it's structured. So it'll be both of us teaching you. And it's going to be the best of both worlds, the FA and the TA combined. I think a lot of you will benefit from it. So I'll leave it at that. Let's do a quick 4-minute break. We'll come back at 11:30, and then we're going to start the second half of this webinar. So we'll see you in like 4 minutes.
Yeah. I see some great questions too. So make sure you guys are getting your questions in. We'll definitely work through those. Both of these are great questions, by the way, Preston and Wheelhouse. I don't know about you guys, but I'm excited for T's part. I'll tell you guys a story. One time I was trading with T and he spotted all of these Baba calls. And I was like, all right, I mean, that's got to be bullish, right? And he goes, these calls are completely bearish. Like this thing is about to crash. And I'm like, wait, what? And sure enough, like he takes puts, and like 5 minutes later, the thing just gets liquidated, like just dumps. And I'm like, wait, what? Like, what did you see in that options flow that told you this thing was about to get liquidated? I
Yeah, I remember this. This was almost
think it
like
was like 2 years ago or
2 years
something
ago. Yeah, I remember. Oh my.
like
I can't believe you remember that one. It was a lot of contracts that were being sold at the bid, and they were all like in the money contracts. That's how I knew. But
Yeah,
there was still like a lot of like mini flow around the bullish activity that was a little sus. And so
yeah,
the combination of those two things was what I had learned from in that moment. But
yeah.
all right, let's start. So now let's jump into the other part of this. So Andrew just covered a very important aspect of trading, which is both sides. And we know in options trading, it's so easy to get convoluted because the moment you see flow, you're very hardwired to think, somebody's betting $1 million on this. Let me, obviously they know something, but a lot of traders miss context. And the context is super important. So here first, let's talk about what is unusual activity, options activity to begin with, right? And typically what this refers to is a abnormally large number of bets using derivatives. That's like the loose term, all right? When trading volume of these contracts reach 5 times or more, then this is deemed unusual, okay? This is general sense. And while this may appear simple, it's far from it because you need to understand that behind the flow, there is a story. And in that story, it is very individualized to the person who took those contracts. As somebody who I used to know and has since passed away, you guys probably know Mike Moss, who was an old trader. He used to be part of the Theta gang in option swing. He used to say, right, that the person who you're buying a contract from is sitting on shares behind those contracts. The shares is what is deriving the options price, not the other way around. And so it's very, very easy to misinterpret the data. And that's why this is a skill on its own to learn. Okay. Now, once again, I want to make sure that all of you understand this. I don't profess to be an expert in this field, and I'm still continually learning about this field because I'm quite new to understanding unusual options activity. It's only been about 2 or 3 years. Remember that I've only started options trading about 6 years ago. So I have 6 years under my belt, but I have 3 years of studying flow, which has helped me a lot in my trading career. So why do you need to learn about unusual options activity if you're a day trader or a swing trader? Well, as Andrew just explained earlier, the exposure levels at which gamma is influenced and delta is influenced is directly correlated to the exposure of the market maker. And when you start to understand their exposure, you can start to see when they're positioning for upcoming moves. When that gamma level is building, when the gamma level is weakening, when gamma is positive and gamma is negative, you need to know the differences between all of those things, which you will go through in the course, okay? But just like level 2 data to analyze order flow, like for aggressiveness, unusual options activities will allow you to catch a move before it happens. Now, why is it that you can catch a move before it happens? Well, it goes back to the first point that I said earlier. It is the equity that drives the derivative price up, not the derivative that drives the equity price up. So the market maker always has to position by buying derivatives first. Then they buy the equity to raise the derivative and equity position up. That's how they make money. And I'm going to go through that in a little bit here. So when volume for a particular day is higher than the open interest, this reflects the sentiment that a move has yet to be made by the market maker, which is what we call accumulation distribution in the Wyckoff cycle, right? But you need to do a deeper analysis to confirm what is the story that the trader is seeing. Because what is driving his sentiment, right? Sometimes it's just BS. So there are obviously good points of UOAs and bad points. So let's look at it objectively, because if you're biased and you say, oh, this is the only thing you need to trade, that's BS also, right? So you cannot just use unusual options activity as your main source of information. It has to be a layer of confluence. So what are some of the pros? The pros is that it gives us a broad understanding of where the dealer's exposure is in single stock options. It allows us to see where the market participants are actively hedging. Like, for example, the whole of last week, I highlighted a bunch of QQQ puts that have been coming in, right, near the top. And sometimes those things take time to play out, right? And using unusual options activity, you can draw a bigger story on a time frame analysis, which can be surprisingly rewarding. Sometimes you can build case studies around the idea, and that I find to be a very good swing trading tool, right? But then obviously with the good, there are some bad. So what are the bad? Well, we can never be 100% certain of the reason behind every single trade, right? And this may cause us to develop confirmation bias, right? Or all kinds of biases. There's hindsight bias, there's confirmation bias, right? And then unusual flow is typically abundant and messy, right? Because there's an overload of information. I can guarantee out of all 54 of you that are right here, a lot of you don't look at it because it's just too much, right? How many of you feel that way? If you feel that way, say yes, right? And obviously, smart money is not always right. Smart money can be wrong. It doesn't mean that they're always going to be right. And that's when people cherry pick the data points and they don't follow all of it. And that's when they get themselves into a mess, right? All of these things contribute to spirals. The trader spirals and makes more wrong decisions after making the initial wrong decision. And that's what causes a blow up of an account. So many traders, what they do is they ignore their own due diligence process. They just like get hardwired to think this is the flow. Somebody's bet millions of dollars. It's right. And then in return, they're tempted by the high percentage of gains and boom, that's all you need. Recipe of disaster, right? So let me introduce to you the institutional playbook, right? You need to understand that institutions, they don't just trade naked options. because that is rare that they will take a single-sided option. They have inherent risk that they have to control, and that risk is portfolio-wide. So as Andrew was explaining earlier, when you have a line in the sand, or what we call a key pivot, right? And let's say stock is making its way and coming down, right? There is a brief moment at which you will see something like this, right? And this is what we call liquidity engineering, right? When market maker forces the price down to collect a group of orders that are sitting there unsuspectingly, which are greedy. You see, many people think that the market maker is an asshole doing trying to out to mess with all of you. And that is true, but that it is also at the same time true that this is a mechanics for what I like to call financial Darwinism. It's like the natural selection of the stock market. If you are greedy, you'll be punished. If you are fearful, you'll be punished. So the market maker's job is to see when the market is stretched in sentiment, it corrects it down. Like, come back to earth. That is the job of the market maker. When people are overbuying something, they'll pull it down. Why? Because they are exposed. When you are exposed, they are exposed. So if their exposure is the collective exposure of the market, imagine how much of risk they have to deal with. And therefore, they are always trying to offload that risk and take the other side of the position to capitalize on that capital outlay that they've put out. If today I bet $1,000 hoping to make $10,000, that's a 1 to 10x growth in that $1,000. The market maker wants to be rewarded for taking on that risk. Okay, so how do they do it? Well, when a stock price approaches that liquidity engineering level, right, they are very, very likely to, first of all, sell puts and buy calls. This is a net bullish position. This is a net bullish position. Okay, and they will never buy calls outright. They will always take a debit spread. So this will have a negative positive, which will net out to be a positive premium move. And then the sold puts will typically also have a credit side to it, which will have a negative positive, and this will also have a positive premium to it. After they have positioned themselves here and they're all set for the move, is where they will gradually deploy capital for equity. You see, the deployment of capital for equity is not primarily for capital gains. It is to inspire others to also gradually buy equity. That's where us professional traders come in the mix. This is where we see the opportunity, the breakouts, the bounces. That's what this is. It's the gradual buying, right? And then when everybody starts slamming into it, this is what happens, right? Boom. And what does the market maker do? They have to now reverse themselves out of this position. So they will not gradually sell equity first. What they will do is they will take profits on these as they're going up. Take profits, take profits, take profits, take profits. Once they get up here, it's time for another liquidity engineering move because people have gotten too greedy. And what do? This is where they will buy puts, but once again, a debit spread kind of move. They will sell calls, once again, a sell credit spread kind of move. And once they are positioned for the reversal, they will then reverse their equity position and go from net long to neutral. And once everybody's overexposed, they will go short. So this is how institutions and market makers play the game. This is what you need to learn how to do it. So all these steps, the nitty gritty, how do you do this is going to be taught to you during the courses that are coming up. Okay, that's what we're going to be focusing on.
T, real quick, Peter says he can't see your screen.
Wait, what?
Can everybody see T's screen?
Can you guys see my screen? Yeah.
Okay. Yeah, everyone's saying yeah.
Okay.
Okay.
So now, important. Sentiment itself, right? What is the speculation? What are people speculating in the options world? You need to know that. There are only a handful of things, actually, right? There's catalysts, upcoming events, right? Your CPI this week is going to be one of them. Your PPI on Thursday is going to be one of them. Your FOMC next week is going to be one of them. So this week, you will start to see traders start to bet on these outcomes. Now, if you already have a preconceived notion in your head of what the trend is going to be like, then the smart move here is not to look for confirmations for your own theory, but it's to look for confirmations opposing to a theory, because you are already sure of what you know is going to happen. But you need to look for things that can prove your idea wrong. That is important. The second thing that can happen is hedging dynamics. And we've been starting to see this last week. People are starting to take some downside exposure. There's QQQ puts being bought. Tech is being hedged on, right? The third is insider information. Sometimes you see unusual options activity for a stock that's like complete shit. You don't even know, like random things. And you'll be like, what the heck is going on? Next day, stock is up 30%, right? So how does that happen? Well, obviously someone knew the information prior, right? Come on, right? And then the third one are technical setups. And these are probably the more common ones. These happen the most often. Pennant breakouts, bounces, rejections, right? You can see that kind of flow. It's instantaneous. Traders are taking those trades immediately to position themselves. But remember that when you see the derivatives, the equity positioning is coming to follow. If the move has already happened, ignore it, right? So what are the different types of flow? There is one-off flow. This is the type that just shows up once and then no follow-up action. And it's usually low dollar amount, very high risk to reward. Like 1:20, 1:30, like $100,000 bets, $75,000 bets. This is the one-off flow I'm talking about. Then you have repeat flow. This is where that flow keeps showing up throughout the week. You have it, you'll see it once and you'll see it a second time, you'll see it a third time, you'll be like, but then it doesn't match the trend of the stock. Okay. So you're like, wait a minute, I'm not quite sure, right? Then you have repeat multi-exchange and high volume sweeps. This is what we saw when I showed you guys NVDA a couple of weeks back. Remember when I told you guys it was almost close to 200 million NVDA, right? Let's have a look at how that played out, right? Very quickly. So for example, this is where the flow came in this area. Now, imagine what has happened since then. NVIDIA came down, went up, came down, came up, and down, and they're still holding those calls. They truly take time for trades to play out, right? It takes a really long amount of time, and they were betting on very high strikes, FYI. They were betting up here, right? So the move has yet to happen, right, with this. And they were all betting on January towards March next year, right? So the move has yet to happen with this. And then last, you have hedging flow. And this is when institutions want to protect long-term positions. These are actually, in my opinion, the easiest ones to spot. They have a very defined category, and we'll go through them in the course, okay? So how do you, first of all, read the data? Okay, so a lot of you are in the Discord across Andrew's and mine. And Andrew's Discord also has options flow, which you can look at. He also covers gamma and delta flow, which is another offshoot of this. But how do you read the data? So for example, you have the options flow here, right? So first of all, the type of flow. Is it a sweep? Is it a split? Is it a block? Is it a dark pool? What kind of flow? Well, it will usually tell you. Sometimes the word sweep will be here, multi-sweep. That means it's swept from multiple exchanges. And I'm going to go through what a sweep, a split, and a block is in the slides to follow. So hang tight, okay? Then you have expiration, right? Which is basically what is the call's expiration, right? Then you have the strike price, which is what the strike price was bought at. Then you have the spot price, and that's what price was the equity when this option was bought. Sometimes that will be available, sometimes that will not be available. For this over here, it was 139.50. Like for example, here, this contract was bought at 139.56, so 6 cents more, right? But two different contracts, right? And then you'll have, after that, the total premium, which is your 1.3 million here, 1.3 million here, 1.43 million here. And then you'll have the contract price sometimes, where they will tell you how much each contract was. In this case over here, it doesn't show it to you, but in some cases it does. And then you'll have volume and open interest, which you'll be able to track on the options chain. And this is mainly to help you see whether the day between each day has changed. Has sentiment changed? Because you see, open interest, which is the next thing I'm going to talk about, is a very important telling factor about whether flow is still usable or not. If open interest increased by 5,000 one day and the next day it's minus 1,000, that means it's now from 5,000, it's gone down to negative 1,000. That means 6,000 people sold contracts. and they took profits or something happened. And you need to piece that together with the information that you see in the charts. You have to piece that with the information that Andrew puts out. You have to piece that with the macro information that we cover every Sunday on the webinars. Everything is a part of your decision making. It's not one. And this is the reason why trading is such a difficult profession, because it's multidisciplinary. You have to understand multiple things at the same time. It's not just one thing. Though if you keep it simple and you focus on risk management, life gets a lot easier, right? So the different types of contracts. What are sweeps? Sweeps are large orders across various exchanges, and they pay the market price, meaning they are paying at the ask. Okay? And this indicates a sense of urgency to get into the position and is considered aggressive and directional. Now, splits, on the other hand, this is like a sweep, but splits are orders that are often broken down and executed into smaller orders. However, it's still only one single exchange. One exchange processed all the orders, but they broke it down. That's what a split is. What has happened here is typically that the trader wanted to get a certain price, and they've put a conditional order where they will fill between this price and this price. And so therefore, that order gets processed as a split. So this is somebody who's a bit more like not so urgent, but just wants to get filled in the general area. Okay, so not as aggressive or not as urgent. Then you have blocks. Sometimes I show you these. It's when you see the ticker symbols are weird. NVDA 2, Tesla 2, right? And then the exchange is a dark pool. You'll see it's a dark pool because it'll be a European exchange. Who the hell is trading a European market in America? Some person who's trying to hide the trade, right? So a large privately negotiated order executed by institutions with major financial backing. Typically, blocks are orchestrated by who? They're orchestrated by the prime brokers, the guys that are brokering for mutual funds, hedge funds, all the bigger institutions, because those guys have a direct line with the broker. Hey, Wall Street Bets kind of vibe, right? Like, I need this contract, but I'm not buying it at the market price. So then the broker's like, okay, I'll give you a better fill, right? And they negotiate on the fill, and that agreed upon thing is a unique order, right? So it's not part of the options chain. Actually, it's kind of a privately negotiated trade. So that's what we call a block trade. Okay, and then you have finally dark pools. This is where the block trades go on to be undetected. So now the prime broker will say, do you want it in a dark pool or not? The guy will be like, I want it in a dark pool. So they will then send your order around the world to a European exchange to clear. The order is executed obviously instantaneously, but then everybody else in the market only sees it 72 hours later. That's the beauty of dark pool. So their order is hidden. And this is important for big institutions and hedge funds especially, because remember, as a retail trader, you fear the market maker, but hedge funds fear other bigger whales. And that's what you need to understand. There is levels to this shit, right? You might be scared of a small town market maker, but then hedge funds are scared of bigger moves. So how do you put it all together? What should you look for? Well, three main things, and we will dive into these into extreme detail during the course, right? We want to be able to identify orders that are odd numbered, first of all, because there's a lower chance of a spread being here. See, when there's a spread, that means there's a buy and a sell of a opposing contract. And so therefore, when the number of open interest is an odd number, there's a chance that it's directional. Okay. And this means that it's directional, multi-hits of repeat flow that are sweeps. That's what we look for in quantity traded. When we talk about premium, how much of the money are they putting to work, right? We are typically looking for more than 500,000 in premium on contracts that will expire urgently. The more shorter the expiry with more premium is a more like, how would I say? It's a more risky bet. And when institutions are making high risk bets, they're expecting big payouts. They're not putting $500,000 to make $500,000. There's no way, right? They make $500,000 to make 5 million. That sounds more right? So when we look at like hard-hitting contracts, short expiries, that's like someone with high conviction. That's how I spot that. So premium value does tell you a story. And lastly, it's expiry and increasing open interest. And this is when we see repeat flow that is seeing increasing open interest, that open interest is building over the days. It's kind of like the same. So by the way, mirroring this with what Andrew teaches you guys, that is your gamma building up, right? That's your gamma exposure. It's building up. So when we see increasing open interest, that's in line with gamma building. And if you see both of those things happen at the same time while the stock is still suppressed, then a big move is about to come. But if you see that while the stock has already moved, you need to check yourself. You need to take a step back and re-observe what's going on because the move has already happened, right? So while volume is higher on the day, it is less likely that a move will happen if we see that there is increasing open interest in the short term. Okay. So this is a good little overview for unusual options activity for you guys for this little short webinar. Now, I know, listen, there's too much to go over here. This is the reason why me and Andrew were like, there's no fucking way we can do it, right? There's no way we can explain to you everything in one session. This is the reason why we came out with the course, because we were like, okay, people need to sit down and learn this seriously. And we don't want people turning up who are not serious about this because this is a niche area of trading. It's not for everyone, let's be real, right? This is for people who really want to master this craft specifically. And a lot of you would benefit, okay? So there will be the course coming up. I highly recommend all of y'all to be a part of it. We have 30 spots. After 30 go, me and Andrew will make a call if we want to let more people in, but we want to keep it to 30 because we want it tight-knit. And I hope that you guys will join us. So now we're going to open up the, discussions for questions. I know there were some questions. Let's see the first one here by Preston. Is it the same risk profile for short calls as long calls? I've seen a lot of shorts being called in early, causing major deficits due to 100 shares needed to purchase. Okay, so to answer your question in the most simple way, always remember something. The market is always naturally slanted towards puts. Okay? Because the natural positioning of the market for many of these single stocks are bullish. Imagine like stocks like Amazon, NVDA, Apple, Microsoft, Google. Nobody is actually actively shorting these stocks. They're holding them long term. And so when you're holding a long term position, your natural slant is always to buy puts because you're protecting that position. The same goes for SPY. The same goes for QQQ. If you don't believe me, let me show you. I'll pull it up right now. So let's go open interest, okay? And let's go SPY. So, oh wait, I don't want to do it like this actually. I want to do OI and then where is that command where it shows you the chart? Let's see if I can put it. Is it here? No. Okay, well, you can kind of see it from here. It's just not a very good visual. I was trying to show you one with the table because it's more obvious, but like you can see this visual here. Okay. Look at the puts versus call activity just for SPY right now, right? Where do you think a lot of the action is? It's all here, dude. Why? Because everyone's hedging, right? It's not, this is it's a natural state of the market. People have to hedge. So you can see the distribution of calls, right? Here. It's concentrated here. But look at the distribution of puts. It's very, very spread out, but it's mostly all much higher, right? It's past 300,000 almost on every single level, 200,000 on every single level. Here, it's like less than 100,000. You can see the skew is more towards puts. So yes, to answer your question, there is always a more bigger skew towards puts. And therefore, when those contracts are sold, it increases the dynamics of the potential deficits of shares. So if positions are like a lot of people are in sold puts, then the market maker may choose to call in those contracts earlier. That's why that happens. Okay. Next question. How important is days to expiration when looking at dealers' possible hedging? If a contract is 2 days to expiry versus 2 days, does that change how you view dealer actions or hedging? Do you want to take this one, Andrew?
Yeah. Think about it the same way if you're holding a contract, right? Like if you're holding a contract that expires in, let's say, 2 days, and that contract goes in the money, how fast does that contract move because of the gamma, right? And if the contract is moving faster, then the dealer has to buy more shares more aggressively to hedge that risk versus, let's say, they're holding a contract that expires in 3 weeks and that contract is moving upwards, right? They don't have to buy as many shares to hedge that risk because the contracts aren't moving as fast. So normally what I'll see in that situation is the gamma level will get, or the not the gamma level, the buying pressure level will get bigger because of the amount of hedging that the market maker has to take on if that level is broken. Now, keep in mind, the level has to be broken because if the level's not broken, the market maker technically doesn't have to do anything
Mm-hmm.
because the contract will still expire worthless. So just because, let's say let's say the contract is 605 and the price is at 600 and the price pushes up to 604, the market maker doesn't actually have to hedge yet. They're down on the position from a contract standpoint, but the equity that they're holding to sell those contracts is still positive. So they're still net positive on the day. It's
Exactly.
once those shares go over the strike price and go in the money, then they have to start to buy to hedge the risk of what they're losing on selling those contracts at a loss. So that I hope that answers it.
Yeah.
Um,
That answers it.
but yes, the gamma buildup would cause them to hedge more aggressively.
Okay, next question. How would you notice that open interest is increasing? Okay, so this is where part of the Discord comes in a little bit, right? So you pay for that kind of information. It's very difficult to track on your own because imagine going through hundreds of Excel sheets a day trying to see which stocks open interest change. Now, the good thing is in the research reports channel in Discord, every single day at the beginning of the day, we get open interest changes delivered to us for the tickers that are high volume. So when things are, for example, I'm just going to try and find one for you so I can show it to you. Uh, sorry, take me a second. I have so much shit here, bro. This is all the volume charts. Essentially, at the beginning, here we go. Yeah. So at the beginning of the day, like for example, right now, these stocks are kind of hot, right? Tesla, NVDA, Roblox, PLTR Sound, GME, Unity, Uber, Coin, Intel, all of them. So we'll get these charts where we can actually see the entire options chain and what's changed. You can see the open interest change for every single contract that's expiring soon here. So for the entire option chain. And you can see which side they were. Bid, ask, mid. What's the details? You see this? To Tesla, that's a block order. That's a private exchange order. You see how it says Flex Euro PM? What do you think that is? That's a fucking dark pool, right? This is a private order that went in. Well, we can see it because we see it going through here and we have access to prime broker report. So this is one way that you can see it. The other way is obviously the old-fashioned way. You go see what the open interest is yesterday, and then you see what it is today, calculate the net delta, and then you get your answer, right? Up to you which way you want to do it. It's provided for you in the Discord. But that's how you track open interest change.
Yep.
Questions? More questions? Did you guys enjoy the webinar? I feel like I need feedback because then we know how to like direction this further in the future. But I would love feedback from you guys on how you found the webinar. If it was informational for you guys, do you feel more confident looking at data from now on? Do you understand it better? Where can we buy this? Okay, so later today, I will be sending out the link for how you can sign up for the early bird sign up. People who want to sign up, you can sign up right away. Okay, we'll allow you to sign up right away. But I'm going to tell you guys it's going to go really fast because I already know that there are at least 10 people who said they're going to sign up. So there's literally only about 20 spots left. I'm being real with you guys. So the longer you take to sign up, the less chance you will get a spot. Okay. I just want to be very transparent and honest with you guys. That's all. This was very helpful. Can't wait to get the course. Thank you, Dom. Appreciate that. I learned a lot using the Discord. Is still not the easiest thing. Absolutely. It's just like everything. You have to put it all together. And remember, as I said, we're all on this journey together, right? A lot of you don't have a space to talk about these things with people. I mean, a lot of you, your family doesn't even believe in what you do. My first 6 years of trading, my family thought I was BSing. They thought like I'm never gonna make it. $50,000 losses, and they were like, "You're just gonna you're gonna destroy your life." But then on year 6, when I made $150,000, guess what? That all went away in one fucking day, right? All of a sudden, then they take you seriously, right? So you gotta put in the time, you gotta put in the effort, you gotta put in all the layers of discipline, and you don't understand that psychology comes in so much later in your trading career. Get down the easy things first, the mechanics, the that regimentation, the discipline, sitting in front of your computer, put in the freaking time into the charts, put in the time into trading, and then everything else falls into line. We appreciate you guys a lot. And if we don't get in the course now, will you guys offer it again sooner than later? So I don't think so, because what we're going to be doing is this event here, the Becoming a Market Maker event, is going to be in January. And then we are planning to offer a more detailed version of that course later. So there will be the next version of that course, which will then include how do you use wheel setups and also pretty much mimic the market maker perfectly. So there's going to be this, which will be the kind of introductory course to what we're trying to talk about. And then the next one down the line will be even more detailed, because this requires you to understand the base layer first. And the base layer will take us 2 days to teach you. For those of you that are, wondering what the curriculum will be for the course, I will put it out very soon. Okay. And then you'll be able to see for yourself.
I don't have the research reports on Beautiful. It's only if T posts them on his
Oh,
channel.
don't worry. I'll post them from, like, I'm gonna make it a habit now to post the open interest onto your Discord under T's updates. So look for it under T's updates. I'll post
I
it.
think one thing to keep in mind too, guys, like we're not trying to gatekeep.
Yeah.
So if 30 spots get taken up, like we will open more spots for
Yeah,
people.
yeah, yeah, yeah.
You also know that, we've always been transparent, right? That
Yeah.
like we want people that want to come be a part of this, want to learn, want to grow. And so that's why we selected 30 spots, right? Is we thought that was a good number for people that would be interested. But if there's a higher demand for it and people, the 30 spots fill up and more people are like, hey,
Yeah.
we want in, we're not going to
Yeah,
gatekeep people and be
and
like, oh, well, sorry, sucks to be you.
yeah,
We're gonna open more spots.
yeah,
But we
absolutely.
also believe that 30 is a good number for the amount of people that we think would find value in
Yeah.
this type of class, because it is a different class than anything that I've taught personally, that T's taught personally.
Yeah.
We've had a lot of meetings together as we've talked about the content,
Yeah.
and how we think it would be beneficial to explain this information to retail traders, to be able to apply, risk at the right time and kind of understand what's going on in the market. So we're not going to try to gatekeep. We're not going to be like, hey, it's 30, sucks for you guys. That's just a number that we came up with, and we said, hey, we think this number is a fair number. We think, there's 30 people out there that would find value in a 2-day class,
Yeah.
and would want to be there and want to participate and ask questions. But if there's a higher demand for it, then yes, we will make sure that people that want to be a part of it and want to put in that time and effort to grow have the ability to put in that time and effort to grow.
Yeah. Now, one very important announcement. Me and Andrew have always been very true to one thing, which is making sure that money is not the issue for anybody who wants to learn. Yes, obviously there is a part of this where we also want to safeguard the sanctity of the learning space, because if we keep it too cheap, then we open the floodgates to people who are kind of not being serious about it. And so if anybody out there who wants to take the course and you're struggling with payment, you can't afford $291 for the early bird right now, but then you still want to do it, reach out to us. Let us see how we can help you. We don't want you to feel like, man, it's the price that's keeping me out of this. We want to help as many of you as possible. That's our aim. That was the aim since we both started doing this, and we want to stay true to that. So if you ever like have an issue with that, please just, let us know. Work is keeping me out. Oh man, Jerome. Well, the course will be recorded, so you will have access to it for life. FYI, I'll be uploading it onto a Google Drive, and you will have the links for all of them, so you can watch it in your own time as well, Jerome. Of course, it'll be recorded for sure. It's 2 days.
Yeah.
I mean, it'll be about 3-hour sessions. We'll have breaks. We might change the format a little bit in terms of like how long it'll be, but I think it'll be a really good one for you guys to kick off 2025 with. So I'm very excited. But anyway, it has crossing over the 1 hour mark now. So I'm gonna go ahead and stop the recording here, and then obviously I'll leave anybody else who wants to ask questions and all that, or if you just want to chill and hang out here for a little bit. I think we'll all leave in like maybe 15 minutes or so. So I'll stop recording here.